second question that we get asked, which is a valid question, is why did you invest in Nykaa and why did you effectively exit it so quickly? Now, we've always been investors who come from investing with cash flows, investing in positive unit economics, and investing in the promoter, along with good corporate governance. Now, one of the core theses of investing where we took a startup position in Nykaa was the BPC segment, which is the beauty and cosmetics segment, was the core margin driver. Now, the gross margin of Nykaa from this segment was at 44%. The next competitor of Nykaa in the private market space is not listed, is operating at a gross margin of 18.5%. Some of the best beauty and cosmetics brands globally. So if you take Estee Lauder for an example, operates, because it has a private label brand, operates at a 60% gross profit margin. And Nykaa was actually expanding into the private label category. And we had expected that gross margin to accrue into Nykaa when we had made this investment. Nykaa had always generated positive unit economics at a cash flow level, both pre-IPO as well as post-IPO. And it's one of the reasons why the promoters had to dilute roughly 49% since inception of the company. The scope for this BPC category was roughly to grow around 3x over the next 4 years. That's how we'd anticipated, along with the fact that the B2B that they were entering into was a much larger market share, almost 4x the category of the B2C segment, which is where we saw significant volume accretion for us as minority shareholders. So all this meant there was a potential. So we invested when the top line was around 2,300 crores. Today it's around 3,800 crores. And we believe that the top line has ability to grow to almost 12,000 crores in by FY26, which meant there was a potential possibility of a doubling of the market cap over the next 3 years. So we took a startup position in Nykaa. Now, why did we change our mind and decide to exit at a loss? The expansion of the company currently, from a focus area, from a capital allocation perspective, is happening on the fashion category. The fashion as a business has much lower gross margins than BPC as a business. It's almost roughly half. And that's where they're tying up with athleisure brands, sports brands in order to move into the fashion category. Now, capital allocation started moving away from BPC into expansion of offline salons. And that's not something that we are a big fan of, because in the first 4 or 5 years of setting up salons and scaling it, it is going to be a very capital intensive business. More importantly, some of the business heads who are actually responsible for the BPC and taking them into the private label category quit. And finally, bonus is generally issued by companies for rewarding retail shareholders. So when a company does well, effectively you've seen it, the genesis for India comes from IT, but bonus is generally issued to reward retail shareholders when the company is doing well. The fact that they issued a bonus to us sounded like they were looking at increasing the liquidity of the stock from retail rather than anything else. And this, according to us, was poor corporate governance. Considering the fact that the focus areas changed, corporate governance suddenly changed, as well as the fact that the areas we wanted to focus on was where we saw some senior exits, made us uncomfortable. So even though we had to take a 30% loss, the loss at overall fund level less than 1% of NAV, it was prudent for us to completely exit when the facts changed.